We're digging into the Federal Reserve today. Originally, the goal was to talk just about the structural changes that could occur and what spillovers those could create under new Fed Chairman Kevin Warsh. He oversaw his first policy committee meeting last week. However, Monday morning brought some additional sad news. Former Chairman Alan Greenspan passed away on Monday. He died at age 100, something we can all hope for and certainly want to celebrate today. More reason to think about Fed regimes. My co-host Sebastian Mallaby is on the road this week. He and I will have to come back to Greenspan at some point. Sebastian wrote a definitive biography of the former Fed chairman that was published in 2016. That said, I feel incredibly lucky today. I have the perfect guest to help me think about implications of both of these events, and that's Roger Ferguson, former vice chair of the Federal Reserve and someone who worked side by side with Greenspan during an important time for the economy and financial markets. I'm Rebecca Patterson, and this is The Spillover. Roger, welcome to The Spillover. It's great to have you here.
Rebecca, thank you so much. I'm looking forward to the conversation.
Roger, your time at the Fed from 1999 to 2006 overlapped with Greenspan's, I believe it was 20 or so year tenure as chair, and you worked side by side with him for several years. Maybe before we talk about the most important central bank in the world and where it may go in the future under Warsh, we can take a minute and look back at Greenspan's legacy and some lessons learned that might be helpful as we think about what could happen next with the Fed. I was working mainly as a currency researcher in JP Morgan's investment bank while you were at the Fed working with Greenspan and then I believe the beginning of Bernanke's tenure. A lot of my time during that period was trying to understand what the heck Greenspan was saying. And what it meant for financial markets and the economy. From my perch, I was sitting on a trading desk. I honestly think he took pleasure in trying to confuse us. One of my favorite quotes from him was, "If I seem unduly clear to you, you must have misunderstood what I said." And I think that sums him up perfectly. And I'll just share one other quick thing. The first time I ever got to meet him in person, he had made comments just a few weeks prior about currency markets, basically saying that, no one should even try to predict currency markets. It was too difficult. And it was basically like flipping a coin to see which way they would go. And obviously I got paid to forecast currencies. So he was basically saying JP Morgan should just get rid of me. So I approached him and I said, hey, Mr. Chairman, I'm a currency forecaster, and you said that it's just like flipping a coin. And his response to me was, again, spot on. He said, well, maybe some people are better than others at coin flipping. And that comment and plenty of others like it were some of the impressions he left on me. He wasn't terribly concerned with clarity with the markets. We had to do a lot of translation of Fed speak. He was a brilliant, brilliant man and an incredibly comprehensive researcher. He looked at such a wide variety of public and private sector data. And he was someone who really appreciated the link between financial markets and the economy. Even though he didn't always get it right, he understood those feedback loops and how they both fed into each other. I know, you worked side by side with him every single day for several years, and I'm sure you have many different perspectives about Alan Greenspan. I'd be curious what stands out to you about him as Fed chair. What are your strongest memories?
So I've got both professional memories and personal memories. On the professional side, I think what stands out most was the point that you made. He had a phenomenal grasp of the economy. It came from literally looking at the economy every day for more than 50 years. He had his own very unique things that he looked at, things such as railroad card loadings and other things that I think the staff found at best amusing and probably had other words for it. But at the end of the day, he was more right than wrong around the major issues of the day. Certainly even the Fed of today is thinking back to his ability to understand the productivity improvements that occurred during that period, and against the advice of many colleagues and others, held off from raising rates and allowed the economy to grow at a much higher level than many had thought, without inflation, most importantly. Secondly, of course, his ability to handle, crises. Obviously, the Black Monday was the most important, simple statements, and then liquidity as necessary. proved to calm things, but that wasn't the only time. There are other crises as well. I think of the Asian crisis when I was there, obviously the dot-com bust and bubble, all of those things. He led the economy through that. More importantly, he was part of a group of economic policymakers starting in the mid-'60s and going through the second half of the last century that really, helped the U.S. economy grow in a global way that overcame the big challenge of the day, which was the Soviet Union. And so while we think of him primarily as being at the Fed, Alan Greenspan had a long history of advising businesses before he came to the Fed and advising presidents before he came to the Fed. So there's some of the things I remember. It will be recognized that in some ways he wasn't perfect because no one is. He himself, I think, would admit that maybe he thought, self-interest among bankers would drive them to be more prudent than history showed them to be, for sure. And I have to say, at a personal level, he was incredibly pivotal in my career. When I joined the Fed, he didn't know much about me whatsoever. He could have easily dismissed me as a unknown young rookie on the team. But instead, and this was true for everybody, he was incredibly fair. He allowed me to show what I could do. And when the time came, 2 years into my term, to replace the outgoing vice chairman, he made it clear to the president that he would be, happy if I were promoted to being the vice chair. And this was in a short period of time from not knowing me at all to next thing I know, I'm, as you point out, working with him on a daily basis and, sorting things out along with him. And finally, I must point out, on 9/11, when I was the only governor in Washington, he called me towards the end of that Tuesday to ask what had happened. And I didn't know if he was going to attempt to micromanage or what he was going to do. And he did the best thing possible. He listened to what I did. He said, Roger, you've done all the right things. Most importantly, you're in charge. I'm not going to try to micromanage from here. I'm not going to keep you on the phone for hours going through details. And that gave me a great deal of confidence to continue to lead the Fed in his absence. And when he got back to the building on that Wednesday, he checked with the staff, determined I had done a good job, and called me in and said something quite impressive to me, at least, which was, though he had returned, I would still be in charge of running the system until the following Monday when we had an FOMC meeting. And it would have been very easy for him to immediately put his hands on the reins and say, now I'm back, I'm in charge. But instead, he sat in the corner office and prepared for FOMC and other things, and didn't interrupt the running of the system post 9/11 that I had been in charge of for more than a day. So maybe that's more than you want to hear, but both personal and professional, and a unique individual. We were fortunate to have had him for 100 years. I am particularly fortunate to have worked with him during a long period of his career and my career.
Oh, thank you for sharing that. And I mean, I have to think it says a lot about you as much as him that he was confident enough to make you vice chair after only knowing you for a few years. But either way, I'm very grateful that both of you were in those seats the time you were there. I think we could spend our whole conversation today talking about lessons learned from the Greenspan era. But I also want to take the opportunity of having you here, Roger, to talk about what could happen next at the Fed. And maybe we start with this latest policy meeting, which was Kevin Warsh's first as FOMC chair. You wrote an article for the Council on Foreign Relations for CFR about a month ago, and I was rereading it last week, and I was just like, man, Roger called it. I mean, look, you said rates are going to be on hold, no easing bias, shorter statement, no specific forecasts from Warsh or dots on the dot plot, so to speak. And then the announcement of task forces. And I feel like you might have hit a home run there with all of them, or certainly most of them. So well done, you.
Thanks.
And I want to dig into some of that, but I want to start first with the task forces. It was interesting to me immediately after the meeting that if you look at the journalists who attend the Fed press conferences, some of them were a little snarky, frankly, about, oh, it's a task, just give it all to task forces, punt it. I didn't think that was very fair, frankly. I think any new leader at the Fed, at a private sector company, at the government, I mean, you're going to want to get fresh perspective. You're going to want to take a look at the organization and see what can be improved, if anything, and especially with the Fed. I mean, if anything can be improved, that's good for their dual mandate. It's good for the economy. So what's, the downside is it takes a little time. Anyway, I thought that was an interesting reaction by some of the business journalists out there. But my understanding with these task forces, it's going to be some Fed staff, but then a lot of outside experts, again, getting a fresh perspective. They're going to focus on communication. They're going to focus on the inflation mandate. They're going to be looking at data collection and some other initiatives. I'd be curious, you saw when you were at the Fed some similar working group task forces, fresh looks at things. How do you think this one's going to play out? And I have to say just one last thing, it's got to be hard to get these things done, right? If any organization, anyone listening to us is going to know people who are long timers in an organization don't want change. They believe that what they do is good. And so change is uncertainty, change is scary. Enacting change is hard. Loretta Mester, who just retired recently from the Cleveland Fed, she said it can be, and she was referring to the Fed, a little bit of a Hotel California thing. It's easy to add, it's hard to take off. So when you think about your time at the Fed, when you think about Warsh with these 5 task forces, do you think he'll get anything done? Do you think it'll be as fast as he wants? I mean, he's talking about year end possibly to get some proposals back. How do you perceive all this?
First, thank you for the kind words about my article and, maybe hitting a home run. So let me now go to the task forces. As I wrote in that article, it was clear that there were going to be one or more task forces. The Fed is a consensus-driven organization. The chairman is the first among equals, but let me emphasize the among equals part there. All of the governors had in their offices, at least in my day, I think in this day, their commission signed by the president showing that they had been, gone through the process. And in that sense, everyone is equal. And people hold their prerogatives very dearly, to be fair, because each Fed governor has sworn an oath to the Constitution, has an independent right and obligation to do what he or she thinks is right. And so there's always going to have to be some consensus building process, which is true in all organizations, certainly true at the Fed. Secondly, this one is, as outlined, a little different from the ones that I experienced in that there were, based on what Kevin said, Chair Warsh said, there will be some outside members. Now, I don't know if that's members, advisors, participants, et cetera, et cetera. So I think there's some detail. Whenever the Fed does anything, they want to take into account the best academic thinking and thinking from other places. But that's not quite the same as saying these are going to be voting members of these task forces. So let's see some of the details. You ask if it's going to accomplish anything. My experience is actually task forces, if well led and build consensus, do move things forward. You open by talking about Greenspan's tendency to speak Fed speak. What people forget is during the last 3 or 4 years of his tenure, maybe more, we actually moved into the era of modern communication, releasing statements after every meeting, showing, what the vote had been, being clear about the target and interest rates, talking about the bias, the tilt, a little bit of forward guidance. All of that originally started at the tail end of the Greenspan era. And it came out of a series of task forces that actually I happened to chair. And so I say that to say there are examples of taking an institution and a leader on a journey through the use of the task forces. So I would expect to see the same thing here. It's going to be different degrees of impact across the different areas. I think on communication, they can control it themselves. I think there are lots of ideas that almost everyone can coalesce around, having experienced this thus far. He was clear that on inflation, the 2% target is the target. So the question is, are there better ways to measure it? Time will tell on that one. Issues around productivity and other things that he wants to look at, I think all have to be looked at. So point 2, I do think there will be impact. Point 3, pace of timing, slower than maybe one would like. maybe he would like. I don't know what his expectations are. But that's the nature of building consensus.
Yeah.
And so the end of the year is not impossible, but I think it will be uneven. We'll put it that way. And so, count me in the optimistic camp. With you, I would not encourage people to be snarky. I think this is the way change is made. And, this is the kind of thing where you want to, measure twice, cut once. Once you make the change, you're going to have to live with it for a period of time. And so it's important to have really given it the kind of pressure testing in a task force. And so I am fully supportive of what he's doing, not surprised. And I do think there will be some change, even though the time may be a little elongated compared to others.
Yeah. No, thank you for that. I want to dig in a little bit more since you were part of the task force that helped usher in the modern era of Fed communication. From that period to today, we see I'd say an evolution of that, right? If we turn on Bloomberg, CNBC, whatever, almost every day you're going to have a current or former Fed person speaking at least once a day about the economy, financial markets. I've personally worried a little bit that while sophisticated market participants know who to pay attention to, right? So, the vice chair, the chair, the New York Fed president tend to have slightly stronger voices around the FOMC table. The voting members have relatively more influence at that moment in time. And then former Fed officials, certainly educated on the process, have insight, but they're no longer voting. And I worry that sometimes it can create noise, honestly, in that, my mom, for example, college educated, very bright woman, but she's not necessarily going to know off the top of her head who's retired, who's an FMC voter at that moment in time. Do you see areas where maybe the communication, the transparency has gone too far? If you had to pick, if you were Warsh, are there certain things you would pull back on, or do you think this is all good and there's no risk?
Well, there's always risk, right?
Yeah.
Because talking about the past is relatively easy, but even that gets revised, and talking about the future impossible by definition with any degree of confidence. A couple of things I would hope they look at very closely. One is the so-called dot plots.
Yeah.
I think most people find them confusing. They're not exactly a forecast. They are 19 conditional statements. If the economy plays out as an individual policymaker expects, she or he would think rates should be wherever. It's a little hard to know what to do with all of that. And it's been clear, Powell, to some degree, played it down. Warsh certainly has been clear that, he didn't, while he encouraged his colleagues to put in the dot, he didn't himself.
Yeah.
So that strikes me as one that's probably going to be revised and maybe, done away with. I don't know. There is a question of, how often one should have a press conference. Kevin, or Chair Warsh, says something very interesting, which was, there should be press conferences. I think he phrased it, when there's news.
Mm-hmm.
Well, if you haven't moved the rate, is that news? Is that merit a press conference? So we'll see, how he thinks about when and how often there are press conferences. Obviously, this question of forward guidance, became very important when they were at the zero lower bound and they had to attempt to adjust the expectations for rates in order to continue to get the kind of stimulus that they wanted. Becomes far less clear that you want forward guidance. And if you do want it, how do you want it to be phrased? So I think that's something else to look at. The final point you make is, the number of people speaking. I think it's going to be hard to put that back in the bottle. As I said, there's 7 roughly co-equal people on the board. And, the Reserve Bank presidents have local constituencies that want to hear from them, and it's their job to go around their districts. It would be a little odd to go around a district and say, I'm going to say nothing about the economy. I mean, it's like, wait a minute, we invited you to talk to us about the economy. And so I think we're going to have to get used to lots of different voices and recognize that, frankly, none of them matter very much until the committee itself meets. And I think that's a lesson that people have to really understand.
Yeah. Forward guidance is an interesting one to me because just giving the forward guidance to me is not as much of an issue as perhaps some members of the Fed feeling beholden by it. If you say, yeah, we think interest rates are going to stay low for the foreseeable future because of XYZ, and then X or Y change, you could change the forward guidance. I think the situation around exiting quantitative easing around COVID, the sequence of quantitative easing and then rates, that to me was an example of where the Fed might have felt beholden to past statements. So it wasn't the guidance itself, it was how seriously and explicitly the Fed was taking the guidance to guide their actions. So I almost feel like this isn't a market issue, this is a Fed issue.
Isn't it funny? I would have put the shoe on the other foot, so to speak,
Huh.
and said that part of the issue is the committee can give very conditional forward guidance, and the markets say ignore the conditionality and say, "Oh, they definitely do X, Y, or Z." And then when the expected action does not come forward, then the markets would argue, "Oh, the Fed has misled us." And so there's obviously a miscommunication because
Yeah.
forward guidance has always been conditional. We tried various different phrases. There was a point when, would versus might was being used, and then a variety of more complicated and convoluted phrases, et cetera, all of which to suggest a conditionality. That's always been the way the Fed has thought about forward guidance. And the problem, I think, now this is, the former Fed official speaking to a market participant, is the market participants, running with the forward guidance as though it were a foregone conclusion, not
Yeah.
conditional.
Yeah.
I'd also say you raise a slightly different point around forward guidance, which is the construct that if one is giving forward guidance, the market can do much of the work or some of the work for you. So I've been watching the Fed for a long period of time and worked in a different way with Paul Volcker after he had left the Fed. But he was the embodiment of opacity. And in his day, surprising the market was what one would start to do. And it was expected. And academics have sort of taught us, well, wait a minute, that's not necessarily the best thing to do. So one has to think through, to your point, the distinction between beholden to forward guidance versus working with the market, having the market understand your reaction function, and maybe therefore smoothing things as opposed to being disruptive.
Yeah.
And that's sort of the balance that one is trying to strike here. So we'll see how it plays out.
Yeah.
But all of this can be looked at again. And the theory of the case, if I can use a cliche, is let's throw out the bathwater, but hold on to the baby, so to speak.
Indeed. Yeah. No, agreed. I mean, you are threading a needle, I guess, at the end of the day. I'll use my own cliche. I mean, I think about 2013 with the taper tantrum.
Right.
When I go back and I look at all the comments that came from the Fed into that period, there was signaling that quantitative easing was going to be wound down. In other words, the market would have less liquidity than it had before, which could ultimately push up bond yields, et cetera. But when Bernanke made a specific comment, I believe it was May 2013, we had an outsized market reaction, and then we quickly had global contagion, a huge sell-off in emerging markets. That's the spillovers from the communications. But then, people are saying, "Oh, he wasn't clear. He wasn't clear." I mean, he hinted at it repeatedly beforehand. So again, it just goes back to how do you get the exact right level of communications that maybe you won't ever. But at the end of the day, I think I lean towards you that you want to have enough that you don't create unnecessary volatility in the market. You don't want to create moral hazard by saying, "Oh, the Fed will always smooth volatility through communication and forward guidance," but you also don't want to structurally increase volatility in the market just because you're going to make the market participants work for it. Like that doesn't seem like a good trade either.
I think you're right. And can I pick up one other point that you made, which is, when to exit quantitative easing? I think that's less an issue about forward guidance and frankly, more issue about having a framework.
Mm.
The use of the balance sheet as a monetary policy tool or as a financial stability tool, we had to do it on 9/11, but it was short-lived for a specific crisis and pulled back pretty quickly. after the great financial crisis, and certainly when they're at the zero bound, um, there was no guidance, there was no framework on how quickly you pull back. And around the world, central banks moved, very differently.
Yeah.
I think the Bank of England probably pulled back much more quickly. But on the other hand, to the point that you made, only the U.S. central bank is actually in many ways responsible for financial stability, or not legally accountable, but impacts financial stability across the board.
Mm-hmm.
And people around the world focus very much on what we do. Consequently, I think the Fed may have been a little more cautious than perhaps history would have judged wise, but I think for good reason. But I think that's less about forward guidance and communication and much more about a framework. When we are using the balance sheet, when are we doing quantitative easing, how quickly do we pull back, and why and how, et cetera. And all that has never actually been thought through or worked out.
Maybe that will be another topic that Warsh is looking at more carefully. It certainly seems top of mind for him.
Well, it is one of his five.
Right.
I think is in his listing. I think it was the second or third that he listed after communication. So
Yeah.
I would expect a framework around when and how to use the balance sheet as a financial stability tool.
I think that kind of clarity would be welcome. I could keep going down our Fed operations rabbit hole here, but I do want to talk about the economy as well. And again, just to anchor this, why a deep dive on the Fed? Obviously, the spillovers from the Fed are global and broad-based, right? Everything the Fed does anchors the U.S. bond yield curve. That flows into the real economy. It affects the dollar. All of those things affect the global markets and global economies. So I think it's great for us to be digging in a little deep here, even if it's a bit inside baseball. But again, let's go to the economy for a minute. The FOMC statement last week, shorter than we've had in the past, but still gave you some good information. They're focused on oil prices, how they're affecting inflation. They're focusing on improving employment numbers. They noted strong productivity growth supporting the economy. And last week, in addition to all this other stuff, we did have hopefully the beginning of a process to get to a resolution of the war in Iran. And if that happens, and we'll see, then in theory, the energy-driven inflation should fade in the coming months. And the productivity question around AI, like who knows when and exactly how big, but it's a possibility that productivity could be a disinflationary force. And then you have, on the other side, you have a pretty resilient labor market, not a lot of hiring, but still the unemployment rate holding steady for a variety of reasons we know. We have very easy financial conditions. We have pretty good consumer spending, albeit not broadly shared. I mean, to me, that doesn't say ease at all. It probably says you hold steady and perhaps even with a bias towards easing, which is what's discounted in the financial markets today. I mean, if you were still at the Fed, we're not going to talk about dots anymore, but where would you be leaning given the economic environment we're in now?
Well, I've written and said a few places, and now say it here as well. I would definitely be in the camp of thinking that it was probably time to hike. Chair Warsh started with something really important, which is it's been 5 years since the Fed hit its inflation target. To me, it looks like core inflation now is stuck somewhere over 3, not quickly returning to 2 based on anything that one can see. You point out that the geopolitics may resolve itself, but the destruction of infrastructure has already occurred. The need to, reopen the strait, it's not clear if the Strait of Hormuz is going to be open free of passage or with, various kinds of tolls and tariffs and things, which will play into the level of prices. So, all of those things are to be resolved. And it's against a backdrop of inflation that has been running hot for a period of time. So, no one should be surprised. And I think the markets are now pricing in the possibility of one hike this year, maybe one next year. I'm now starting to see some talk of, because Chair Warsh sounded, to use the word hawkish, some talk of hikes earlier rather than later. I don't know if that's going to be borne out. But I think he's going to have to do something. The committee's going to have to do something to put a little bit of seriousness behind the bold statement that we will return to 2%. I don't know if they're going to regret that statement because getting to 2% may be harder than we imagine for many structural reasons. And so we'll find out. The other
Yeah.
thing that you put your finger on that's really important is, I mean, everything you said is important, but the AI world right now, you know, wherever happens vis-a-vis AI and disinflationary pressures in the future, it seems to me right now what AI is driving mainly is an increase in capital expenditures, calling for more savings to go out, and that means to me market rates should be somewhat higher as well to equilibrate increased demand for capital and bring in a greater supply. So I think that also has to be taken into consideration, at least for the intermediate, near to intermediate future.
Yeah, that's a great point. In the last few days, I saw one of the biggest technology providers announcing that they're probably going to be raising prices for some of their consumer goods because some of the inputs that they need, because there's just so much demand right now, is pushing up their costs. So they need to increase prices. So you aren't seeing much disinflation from AI yet. To your point, it's going the other way. There was something else when Kevin Warsh was talking about inflation and where policy is right now, whether it's too restrictive, rates are too high, or too easy, rates are too low. And it was interesting to me. He said, look, I could say they're too restrictive, too easy, depending on where in the economy I look. So he pointed to the housing market and saying, from that vantage point, maybe interest rates are too high and the housing market is struggling. Mortgage rates are high. And then he talked about other parts of the economy, like financial conditions, and saying, in that case, you could argue we do need higher rates. I appreciate his point on housing, but of course, he, and I all know that policy rates are just one of many factors that affect the housing market. And right now, to me, it would seem that the supply versus demand of long-term treasury yields or bonds, which affect mortgage rates, is probably a bigger deal than the Fed funds rate for housing. Doing something with Fed funds isn't going to solve housing. So I'm just curious, if you have any thoughts on the housing market and longer term yields, but also when you were sitting around the FOMC table, obviously someone coming from one part of the country might have a different view on that region and what the right rate would be. Someone who's focused relatively more on one transmission vehicle for policy might be more biased towards easing. You have to set one rate. You can't have multiple. I think that's the European Central Bank's biggest problem. None of the economies have the same conditions. How do you get to an answer in that case? I guess everyone just weights their models and they work their way there. And I don't know. I'm curious how you think about that. When Warsh said housing says this, financial conditions say that. Yeah, but at the end of the day, you got to add it all up.
You start where you started, and where a point that he made as well, which is just the Fed doesn't control a particular price, the price of milk, the price of eggs, et cetera. It can't control the uneven distribution or transmission of its single tool. We recognize that. That's why we call some sectors interest sensitive.
Right.
The degree of interest sensitivity has evolved and changed over time. But overall, what they should be looking at is inflation, current inflation, expected inflation, forecast inflation, all of those things. And then they have one, we admitted, blunt tool called the short-term interest rates. And that's what they work with. I would say one thing I want to use the word correct you on.
Please.
The 12 Reserve Bank presidents come from different regions. I will say during my, I don't know how many FOMCs I went to, while people talked about conditions in their regions, they very much were thinking national. I didn't hear anyone ever say, well, because I'm in the Farm Belt, boy, I'm going to vote for lower rates, even if inflation looks like it's doing one thing or another. I think it's important. And I think that's also true, by the way, in the European Central Bank. So it's really important to understand that people, as I see them, think about the overall mandate of the Fed, the dual mission, and they're recognizing that it may have will have uneven impact across different parts of the country. And that's, so be it. But, the goal of the Fed is not to support the housing market. It's not to support a particular sector. Frankly, it's not to support contrary to what people think, equity prices. Some people think there's a so-called Fed put. It is to get inflation where it should be. And what I really liked about Kevin's statement was a clarity around that as an intention.
Yeah.
And described the commitment as unanimous and unambiguous, a set of phrases. So now it's all about delivering on that, I think.
Right, right. And sorry if I misspoke. I wasn't suggesting that the regional bank presidents would just represent the view of their region. I'm sure
Yeah, no,
they bring that color to the table to
they bring
share
that.
it. Yeah, yeah. But I'm glad you mentioned that because it's important to be clear, and I clearly was not. I want to hit one more topic. One thing Warsh did not say at this press conference was anything about the Fed's partnership with the Treasury, its partnership with other central banks around the world. And, last week we had a group of 7 meeting in France. We had a lot of leaders together trying to collaborate on different topics. And it does make you think about things like the Fed swap lines, where it provides dollar liquidity to other countries in times of stress. Or Kevin Warsh has talked about a new Fed Treasury Accord, and during the confirmation process, mentioned a little bit what should the Fed do, what should the Treasury do. Just before we wrap up, would love if you have any thoughts on Fed collaboration broadly speaking.
Look, I think it's critical to keep all of that in mind. There's no doubt about that. The U.S. is the engine of growth, and also, sort of the leader of what we used to call the free world. But that absolutely has to work through collaboration, as you point out. In a very technical sense, those swap lines prove to be really important when there are moments of dollar liquidity concerns. Those spill over to the rest of the world, and it's important to have those swap lines in place and to use them. More importantly, we've seen moments when central banks and treasuries are unhappy with exchange rates. Very tricky to manage, but every once in a while, you have an accord that clearly is attempting to influence the way exchange rates work. We have found, for better or for worse, central banks having to think through things like terrorist finance, which again has to be done in a coordinated fashion. And when you get to these meetings, my experience is the other folks around the table, while proud of their nationality and proud of the nations, know that the U.S. is the economy that really drives, global growth, and they look to the U.S. for leadership. Here domestically, there's clearly moments of great coordination with Treasury, for sure. That should not influence or impact the independence of the Fed around setting monetary policy and setting interest rates. But things like exchange rate, that comes out of Treasury. The Fed is an important part of implementation. The same thing was true around something we haven't talked about yet and won't delve into, but bank supervision and regulation. The U.S. is a regulator, or the Fed is a regulator in the U.S., along with the OCC, which is sort of part of the Treasury, and the FDIC and others. And so there are lots of places where, while we have a strongly independent Fed, it is part of a government, and there are places where, coordination comes into play.
I know I could keep going on and on and on about the Fed and its importance and its evolution with you, Roger. But to your point, bank supervision, regulation, payment systems. I know. There's so many other topics, but I also know that we need to wrap it up soon. One thing we do every week during our conversation, Roger, Sebastian and I try to think about something we learned or read or saw in the previous week that struck us as interesting. I'm not sure if I prepared you for this, so I'm not going to put you on the spot if you don't have anything top of mind, but I want to share something real quick before we say goodbye. I just saw this yesterday, yesterday being Sunday, in the South China Morning Post. Fascinating. So going back to AI, China's universities have killed or suspended more than 12,000 undergraduate degrees in the last 4 years. They've introduced 10,000 new degree programs over the same period. So that's about 30% of all their programs changing over 4 years. Basically, the government's saying, if we need more workers here or here, we need training for them, education for them. And if we have too many workers, kill the program. Don't encourage people to go into areas where there won't be jobs. And when we talk about AI, we were talking about it in terms of inflation or disinflation earlier, but there's also the labor force impact and how do you make sure people have jobs in an AI world of the future. Obviously, a little bit easier in China's political system than in America to do that. But that I thought was really striking, just the degree of change and the speed.
No, look, I agree with you. What I really find very interesting is this world of AI is going to be a collision of two views of how one runs an economy, right? We've seen the Chinese version. They think they have a very clear view of the jobs are going to be called for, and those that aren't, and they're going to swing the entire population in a certain direction. I don't know if that's going to work. Think of the one-child policy.
Yep.
Seemed relevant at some point. I think in history, probably not a good choice. In the United States, I will guarantee it's going to be a lot messier. And then the question is, well, do you vote on, one model of figuring out the future where it's controlled by a small number of people, or do you vote on another model of figuring out the future where it's messy, it unfolds, and it's just a constant battle day to day? And I think the most important thing about it is getting our population ready for, the kinds of conversations and disruptions that we're likely to have. And we'll be able to say, at the end of it, we'll have a very productive economy and there'll be brand new jobs that we haven't even imagined today. But in saying that, let's not ignore the cost of those who might lose their jobs today. And so I think we're lucky to be here at this moment of AI, and interesting to see how two different systems deal with the uncertainty that's ahead of us.
Yeah, that's very well said, and I agree with you completely. Well, Roger, thank you again so much for being with me today here on the Spillover to share some of your experiences and perspectives on the Fed, both looking back at the formidable Alan Greenspan and also ahead to the Fed's era under Kevin Warsh. It's going to be an exciting time. For all of you who want to stay up to date on the latest episode of The Spillover, please sign up to receive an email alert when new episodes drop at cfr.org/newsletters or click the link in our show notes. And if you have an idea or just want to chat with us, email podcast@cfr.org and be sure to include The Spillover in the subject line. Our episode today was produced by Molly McAnany, Gabrielle Sierra, and Jeremy Sherlick. Our video editor is Claire Seaton. Our sound designer and audio engineer this week is Marcus Zachariah. And research for this episode was provided by Liza Jacob and Jack Heaney. Subscribe to our show on Apple Podcasts, Spotify, YouTube, or wherever you listen to podcasts.